You're listening to Uranium Spotlight, brought to you by PurePoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and ISO Energy, PurePoint is investing in Canada's uranium future. And now your host, Chris Frostad.
It's Tuesday, September 9th, 2025, and this week on Uranium Spotlight, spot prices hold steady as optimism builds from the WNA Symposium. The World Nuclear Association warns of a looming supply crunch. The U.S. removes import duties on uranium. Kazatomprom triples exploration. And Bannerman lands its first U.S. utility contracts. The uranium spot price closed last week at $75.80 a pound, down only 10 cents from the week before. The August long-term price remains steady at $80. Trading volumes were light as much of the industry gathered in London for the World Nuclear Association Symposium. Early in the week, activity was almost non-existent. Monday and Tuesday passed with no reported deals. The first move came Wednesday with a small uptick to $76 a pound, followed by a Thursday trade that brought us back to $75.80. By Friday, a few transactions were confirmed, reflecting stronger sentiment coming out of the meetings. Market participants at the symposium were broadly upbeat, with many expecting the price trend to push higher, supported by producer cutbacks and Sprott Physical Uranium Trust's continued fundraising. But there's also caution. $80 a pound is viewed as a psychological threshold, and some wonder how the market will respond if we get there quickly. On the term side, utilities used the London meeting to quietly test the waters. No new contract awards were announced, but active requests remain in the market, and historically we've seen term activity pick up in the weeks following the WNA. That could add support to prices as we move into year-end. If you haven't already, be sure to subscribe to Uranium Spotlight Podcast, available on your favorite podcast platform or on PurePoint Uranium's YouTube channel. The uranium market is heading for turbulence, at least according to the World Nuclear Association's latest nuclear fuel report. The warning is clear. Many of today's largest producing uranium mines are expected to wind down in the 2030s, just as new projects are taking longer to move into production. Only a few years ago, the development window was estimated at 8 to 15 years. Now the timeline has stretched to 10 to 20 years. High costs and long lead times aren't the only challenge. Financing uranium mines is unique compared to other commodities. Projects can secure funding for years in advance through long-term supply contracts with utilities, but those contracts depend on confidence that the mine will actually come online, and that confidence is increasingly difficult to place. The report projects that by 2030, production from existing mines could fall by half. With more reactors scheduled to come online and fewer pounds available to fuel them, the WNA calls for immediate investment across the entire fuel cycle, including fresh exploration from uranium miners worldwide. The risk is that the world faces not just one, but several supply crunches over the next decade as depletion outpaces new supply. On top of this, the geopolitical backdrop is becoming more unsettled. Russia and China are vying with the U.S. and its allies for influence over uranium supply chains, particularly in Central Asia and Africa. The challenge for Western nations isn't only how much uranium will be available, but whether they'll be able to secure reliable access to it at all. For investors, the takeaway is straightforward. The first supply crunch of the next decade is approaching. How governments, utilities, and producers respond will shape both the nuclear fuel cycle and uranium prices for years to come. The U.S. administration has decided to remove all import duties on uranium and several other critical minerals, easing back from its broader strategy of using trade restrictions as economic leverage. This move carries weight. For months, utilities have been reluctant to commit to purchases. With 99% of U.S. uranium requirements met through imports, the prospect of adding costs on incoming supply left buyers uncertain about the future pricing. That hesitation slowed contracting and muted spot market activity. With that uncertainty now lifted, we may see utilities step in more aggressively to secure material for next year's reactor needs. To put this in perspective, the U.S. once mined millions of pounds annually. In 2010, production was nearly 5 million pounds. By late last year, output had fallen to just 677,000 pounds after years of virtually no mining between 2019 and 2021. Meanwhile, America operates the world's largest nuclear fleet. 93 reactors consuming more than 40 million pounds of uranium each year. Against that backdrop, the administration's decision makes sense. The World Nuclear Association has already warned of looming supply shortfalls. Adding import costs on top of an already tight market would have only made the situation worse for utilities. For investors, the message is clear. Removing this barrier reduces one layer of risk and could trigger near-term buying from U.S. utilities. But the core challenge remains: domestic supply is negligible. Dependence on foreign uranium is overwhelming, and with global demand tightening against constrained supply, the price outlook continues to lean higher. Kazatomprom, the world's largest uranium producer, has announced plans to triple its exploration efforts over the coming years. At the same time, it's expanding its reach internationally, with joint ventures in Jordan and Mongolia now advancing towards production following new agreements. The timing is telling. Kazatomprom is facing its own production shortfalls by 2026, and it's clear that they see reinvestment as essential, especially as Cameco, the other major producer, is signaling similar challenges. For Kazatomprom, this is about securing future supply and maintaining leadership in a tightening market. The bigger question is, who will benefit from this additional uranium? Western buyers have often been locked out of Kazatomprom deals, leaving China's growing reactor fleet and Russia's allies as the likeliest recipients. With geopolitical barriers increasing, whether it's Russia restricting exports or the U.S. adjusting import duties, the flow of uranium is becoming as much about politics as it is about geology. As the World Nuclear Fuel Report stresses, the global supply crunch will demand not only exploration on a much larger scale, but also faster mine development. Kazatomprom's move is a clear acknowledgement of that reality. The rest of the industry now faces the choice: step up investment in exploration or risk ceding more ground. For investors, the takeaway is clear. Kazatomprom is positioning early, and this underscores both the urgency and the opportunity in uranium equities. Companies funding meaningful exploration today may be the ones best placed when the supply gap fully materializes. Bannerman Energy has just secured its first long-term uranium contracts. On September 5th, the company announced binding contracts with two major U.S. utilities, both Fortune 500 energy providers, for the supply of 1 million pounds of U3O8 from the Etango project in Namibia. Deliveries will run over 5 years, from 2029 through 2033, with a built-in flexibility allowing buyers to adjust volumes up or down by 10% annually. The contracts are structured with a fixed base price, broadly aligned with long-term uranium price indices, and include escalation provisions tied to the U.S. GDP implicit price deflator. Those escalation terms only kick in once deliveries begin. For Bannerman, this marks a strategic milestone. CEO Gavin Chamberlain emphasized that these carefully selected agreements help underpin Etango's path towards a final investment decision, while showing utilities the company's ability to deliver into a tightening uranium market. For investors, the takeaway is clear. These contracts validate Bannerman's credibility as a future supplier, strengthen the financial case for Etango, and highlight growing utility appetite to lock in supply years ahead of need. More broadly, it's another signal that utilities are stepping back into the term market in a meaningful way, an important driver for uranium equities. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by PurePoint Uranium Group. PurePoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.